What is the best rent yield with competing properties that you're looking at? Now, the problem is that a lot of people misuse this yardstick and have no idea how to actually apply it. So in this video, we're gonna show in really simple terms, first of all, what is a cap rate? How do you calculate it? Number two, how do you actually apply it? And number three, how do you use it to compare it between different properties, specifically in the city of Vancouver and British Columbia? The cap rate, or AKA the capitalization rate, measures the unmortgaged rent yields between properties. So it takes everything else being equal, so it's an apples to apples comparison between properties. Why do we not use the mortgage costs? Well, number one, people usually have different down payments, different mortgages at different rates, different amortization periods. So if you actually put in this mortgage calculation in your actual objective rent yield calculation, aka the cap rate, it's got too many variables. So what it does, it takes into account is that when you pay off your mortgage, and we're just operating the property just off of its expenses and its income, things that stay pretty consistent, that's when you have the most objective way to actually calculate what has the most sustainable rent yield. So if you saw the video on net operating income, then you'll understand a little bit more about how to actually apply the cap rate formula in the next few seconds. The formula for cap rate is what is your net operating income, so that's your operating revenue minus your non-mortgage included operating expenses divided by the property value. Now you'll be tempted to perhaps use the property value that you bought it for years ago. That's not the way to do it. That artificially inflates the cap rate. It's what is today's market value. That's in the denominator. And again, you've got in the numerator the net operating income, which is of course revenue minus expenses. Super important you apply that. And this gives us the most, again, objective yardstick around how much return is this property giving you long term. Why a cap rate is actually important, and when you actually use it, I see it as a financial tiebreaker. You're looking at 1, 2, 3, maybe 5 properties. They all look awesome and you're kind of stuck. The payments are very similar per month. So which one do you choose? So with this tiebreaker, when you're actually looking at the cap rate, when you skin away everything else that's variable and will be changed in the future, things that are consistent, assuming you hold this property for a long time, which is the way you have to look at it, it gives you a tiebreaker, right? So that is why it's very important to use it properly and as a tiebreaker between different properties.
So what is the minimum cap rate that people should aim for, Paul?
That's a good question. Now look, a good cap rate, just for a rule of thumb, is it should be at least higher than your current mortgage rate. Now keep in mind, if you're in one of the more expensive cities around Canada, then you may not exactly be at that threshold, but remember, those are usually long-term holds. So cap rate is not the only metric to look at. There are many other metrics that of course include your cash flow and your mortgage costs, which are very important. But objectively speaking, with a cap rate, you gotta keep it isolated, and you just have to be a realist around when do you apply a cap rate and when do you layer on other formulas so you can make a holistic decision. But again, cap rate is the unmortgaged objective tiebreaker between one or more properties for you to see how sustainable it is. You may be wondering, what drives cap rate? Well, we're gonna ask our market real estate expert, Alex Dunbar, to quickly walk us through those factors.
Everything that affects appreciation and higher rents. Let's go over the pros of cap rates. Number one, it's a way to quickly compare similar properties. Number two, it can point out potentially undervalued or overvalued properties. For example, if this home has a net operating income of $32,954.64, which we calculated in our net operating income video, and it's worth $625,000, then the cap rate is 5.27%. For Vancouver, this is a great figure, and it might mean the property is undervalued relative to the yield that it has. Next, let's look at the cons of cap rates. First, they do not take into account financing costs, which can significantly impact profitability of a property. If the rate was 6% on the above example, we're bleeding cash, so if it doesn't appreciate significantly, you're running at a loss.
On that note, if the property appreciates by $100,000 and that lowers the cap rate, again, not a bad thing. You just made $100,000. There are other metrics to show that that's incredible, but still on a 5.27 cap rate on the $625K home that you might have bought, that's still a very solid number. So don't let cap rate blind you from other factors that mean cash in your pocket. So keep that in mind. To summarize, cap rates are excellent and unbiased ways to look at two properties as this objective tiebreaker just to decide which one has the most sustainable revenue. Now, of course, we want to look at other metrics as well, metrics that include your cash flow and of course your absolute borrowing costs per year. Also, we want to look at, well, once you sell the property, which at one point will happen whether you like it or not, what is the exit potential both with or without renovation? So with that, we will catch you in the next video for another layer of how you can get ahead with hidden cost, hidden revenue, and hidden potential in your profit.
If you're a little more curious now than before this video and want an insider scoop on places that give you a holistic ROI
without your finances and your health falling apart, then book us below for a chat.